today. This is Footprint Community FS First video 1. Today I'm going to take you through a weekly review and also Falcon principles, a strategy that will give you a highly win rate and a highly risk to reward percentage. So I have my first model here. So in the FS market, we have a lot of strategies that people are using all around. So I want to take you through the simple Falcon strategy, which we base on positioning and then the signal confirmation for our entry model. So when we talk about the positioning talks about where price is, or where momentum, or let me say where volume is located. When I talk about volume, we have an area in the market where there are a lot of volume being built. That is when price is consolidating. Price consolidates in an area where volume can be built. So at these areas, you see a lot of volume being built, and after the volume being built, a sharp move will take place. That is after the volumes or orders or stop losses has been triggered, then you see a sharp move. So in Falcon strategy, what we do is we positioning ourselves at this area where volume was built, because whenever price is moving towards that area, you know that price is coming to that area in order to get another reversal. So we're positioning ourselves at this area. So I will take you through the chart, and then we see the models that we use in the Falcon strategy. So I have the first one here. Let's consider this ray line or an arrow as an area. So if this was an area, you see that we missed the area with some pips, with some few pips. So this type of trade, people will take this trade. Taking this trade is involved or comes with a lot of risk, because the actual area or where volume has been built, price has to trigger or get to there before we get a reversal. So sometimes people want to get in early. That is fear of missing out. Then they will trigger the move early and then get into it. So getting into this type of trades is very, very risky. Sometimes price will commit in your direction, but at the end will reverse sharply and then hit you or take you out. So this is the second one that we are looking for. So when price comes back again, because there was a missing gap, there was a gap to that area. So when price comes back to that area and then close the gap and trigger the volume, any positioning that you're taking here has a lower risk. That is, you can take a positioning here and then get a good reward. So in Falcon, what we do is that we wait for price to trigger or get to that area, break that area high, and then push back and give us a continuation pattern. That is our first confirmation entry. So when we get this continuation pattern, then we can start looking for entries. And we also have a PS model, that is positioning sequence. So and then entry. The positioning is what we are talking about right now. We are saying that for the positioning, what we will do is that we will just position ourselves at where volume has been built, a value area. And that value area is where volume has been built, right? So you wait for price to come there, and that gives us a signal, but there is no confirmation. The confirmation means when price gets to that area and then we get a push, a very sharp push, we wait. We can't just take a trade from that area, because sometimes price can get to that area and start committing. But when you get in, you use the candle confirmation one also to take the trade. You see that you get in, you tap into the trade and then tap out, you get it. So you wait for a push into the area again and then use a confirmation entry, that is a 1 2 3 touch. Then we take our entries, then we get our entries to the down, we scale in. So the sequence means that the first correction, if the first correction is bigger, or let's say here, let's see this sequence, you see the first correction is smaller than the second correction, because the sequence has to follow in order, because this correction here is bigger than this correction. This means that we are not going to take this trade. You can still build momentum or volume here and then start going out, trickling up. So what we do is that, let's say we have A and B. This is A, for price to commit or move from this area A, sorry to use a small case, A to, let's say, the B positioning. there will be a lot of volume being built before getting to this area. So price can't just move straight away to this area without getting or without volume being built. So what we do is that we use the PSC model, which is the positioning sequence and then the entry. So the first one or the first correction has to be something smaller than the second correction. And then what we usually know or use from the market is that whenever a larger volume or consolidation takes place, this means whenever a move is going to break out of that consolidation area, that move is going to give us a higher momentum, and it can move far than the one with lower momentum or the one with lower correction or volume. So this is the sequence that we are talking about. The first one has to be smaller than the second one, and it depends. So we talk about some key things that we look for. But today we are just going to look for weekly analysis, or let's say weekly chart review. So we have positioning entry, and then positioning entry model, and then we have a confirmation. So what we are looking for is that we have footprints, outside footprints. We also have a hook point. So hook point, let's say we use 1, 2, 3 touch, and a 1, 2, 3 touch with a hook point, something like most people call it liquidity. Those areas, if you get a liquidity or a hook point area with a 1, 2, 3 touch or drive, this type of entry criteria, you can list it or add it to your go-to setup. That is an A+ setup. So whenever you see a setup like this, a continuation with entry and a hook point, you are going to get a higher chance of it playing out. So let me show you. We have a sharp move like this. So in that sharp move, we still get this, and then price starts building momentum or correcting to our hook point, and then you see, sorry, this is not the picture perfect one, and then sometimes we will not get a picture perfect as we want in the market, because the market do or does whatever it wants. You can't drive the market, it is being driven by the big players. So let's see, we have 1, 2, 3 touches here, and this is what we are talking about, the hook point. This is the hook point. So let's see the first touch here. Let's draw our touches below and see how we can utilize this. You can play this on the lower time frame, on the higher time frame, but most of my entries are taken on the lower time frame, 50 minutes. That is where I used to take my entries, and I start my top-down analysis from weekly. Weekly is used for to determine the current trend of the market, either the market is in a downtrend or an uptrend. And I will come to one day. I use the one day to discover the chart patterns, and then also the candlestick information, and I will refine my chart patterns on 4 hour and 1 hour 50 minutes I use for entry. Sometimes you can use 5 minutes, and the reason why I don't like using 5 minutes is that there are always noise on the lower time frame. But if you have a quality setup, you can use 5 minutes to get your entry, but I stick to my 50 minutes to get my entry, and this has been a game changer for most of people in this industry. So first, let's see this is what I'm talking about. This is the hook point. You know that we are from, let's say we are from a valued area or price tap into a footprint area, and then we get our sharp move. Price leave a footprint here, a hook point here. So what we will do is that we want to benefit from this trade, the trade from A to B. So this is our target. So we want to benefit from here, but we didn't start, or we didn't target getting this trade from the top here, because there you can tap in and tap out, and then you get 1% loss, or any of the risk models that you are using. Some people risk 1%, 0.5, 0.25. Some can risk 5% on the trade. It depends on the amount or the capital you have in their account. So what we are doing is that we have a sharp drop, and a footprint being left. So what we do is that we just focus on the entry criteria. This is the 1, 2, 3 drive, whether you use 1 hour or 15 minutes to get it. So most of the times what we consider is that when you're using 15 minutes, you have to get a minimum of 6 candles. That is 6 to 8 candles for you to take the trade. And when you're using 1 hour, the same model, 6 to 8 candles minimum to take the trade. Okay, so let's see, we have a footprint here, or our hook point price. This is the go-to setup I was talking about, and this is one of the A+ setups. Whenever you see, you don't have to think. It is a probability game. whether you lose or you win. But this type of setups, when you take 10, I can guarantee you that your win rate is going to be 80%. That is, you are going to win 8 out of 10, and your losses are just 2, or a break even, and then a 1 miss. So let's see this type of trade. We have one touch. We want to take this high here because the direction for the markets now is a downtrend. So this here, this high failed to break this high, and we get another high which breaks the internal high but not the actual high that we are targeting, and we have a high that breaks the actual high and give us 1 2 3 touch. So here, if you're using 1 hour, you look for 1 hour retracement candle, then boom, we enter this trade. Very simple. Let's say we have a 1 hour retracement candle here, then we put our stop loss just above the candlestick, then we target. For me, my risk reward is the least one is 1:3. So if I'm taking the trade, and the trade is not going to give me 1:3 or the 3% risk or 3% profit or risk reward, then I'm not entering this trade. As you can see, this is 3.7%. So this is what I'm talking about, 3.7. So here, if I am comfortable, I can take here, but we are targeting here, and we have a 90% chance that price will get to. I will teach you that one, but not today. So I can just target. Maybe we have some points of footprint areas, then I'll target here. Let's say here there was a footprint area at this place, then I'll target here for about 7.2%. Then I'll hit myself on the trade. And we have management. Most of the times when you are trading, whenever you get or you move in 1% profit, make sure you move your entry, you move your stop loss to your entry 1% or 1.5%, whatever you are comfortable with, you move to your entry, because getting 1:1 and then hitting stop loss sometimes very painful and can be detrimental to your mental. This is a mental game. So considering hitting stop loss is running 1%, 2%, someone can run 2%, 3%. I have been a victim of this, running 5% and then hitting stop losses. So whenever you move or you get 1% into the prices, the price move 1% into your favor, whatever you need to do is that you move your stop loss right into your entry or to your entry, or you can state like whenever price moves 1.5% into your favor, then you move your stop loss to your entry. This is very simple risk management method, or a way for you to manage your trades. So if this is this is also a 15-minute pattern or correction, you use the same model, a push, then a 15 minutes retracement candle, then you enter your stop losses above, you take the trade, so you can just take your profit here. This is about 3%, so this is okay for me if I'm taking 3%, because I'm always aiming 1:3. But if you know this trade is going to commit sharply today, sometimes you have to consider the day, the time that you're taking the trade. Sometimes there are major moves that can move you to that area, so you won't be out of a trade that can get you maybe more than the percentage you closed for. So you can probably get a percentage, or you can probably close this trade for about 7%, as I was saying. So let me take you to the chart for us to see whatever is going on. I already have my setup playing and I will explain everything to you. So let's start from 1 week. So on the 1 week on Euro USD, let me clean this chart and then do it again. So on the 1 week on Euro USD, let's first talk about the positioning. If we are considering the positioning now, we are in the downtrend. This is positioning number 1 I will choose, because see, volume was built here, and after this volume, C sharp move to the downside. So whenever price gets here, price is going to trigger down. But let me take you to another positioning that played out and that we are currently benefiting. Let's see this one. We have another position over here. We have a 1 2 3 right here. This is the positioning that I'm talking about. So whenever you know where to position yourself in market, you will find it very easy to get trades and be profitable on the FX market. So the first one is this 1 2 3. You see, volume has been built here, and after this, you see how price moved fast. Price moves sharp to a full retracement candle, a bearish engulfing, and from there price committed to the downside successfully. There was a 1 2 3 drive here. So here is where I will position myself for my next trade, and let's see, price try several times to get to this position. So here price came to this area and then failed to reach there. We get some sales, and we still know that this is where we are positioning ourselves as a Falcon student. So I have this setup there that